And the title of this week's audio blog is Unprecedented Hyperinflationary Liquidity Explosion Will Shortly Yield Historic Bull Market in Scarcity Assets. Actually, it's early Sunday morning, and I do meet early. And given how many important topics I have to discuss, I decided to commence the week with an audio blog, which I'll start scripting today and finish tomorrow morning, at which point I'll finish taping. The first being an update on the COMEX commercial short covering, as reported Friday afternoon as of the close of Tuesday, July 18th. Yes, I know I've expressed great skepticism of these statistics in the past, firstly because they're clearly issued as a cartel propaganda tool to be manipulated at will, just like the trading underlying it. And secondly, because the COMEX COT, or Commitment of Traders report, has not had the two-way predictive ability it once did. In other words, commercial short covering, as measured by the COT report, up until about 10 years ago, had nearly a 100% chance of predicting a major price rally, whilst conversely, heavy commercial shorting, with equal reliability, predicted major price slams. However, starting around the time of the 2008 crisis, and secondarily the 2011 point of no return acts in May and September respectively, heavy short covering no longer necessarily meant prices were about to soar, whilst conversely heavy naked shorting activity no longer just predicted but guaranteed major price slams. That said, the correlations are still strong enough to include this data in the overall mosaic of factors worth watching, particularly given the fact that the physical market from a worldwide perspective is as tight as it's ever been. To wit, the past 2 months have seen Indian gold and silver imports on a par with the record year of 2015, whilst Chinese and Russian demand continues to inexorably increase. Per last week's Holy Grail of Bullish Silver Statistics article, silver mine production is expected to plunge roughly 30% in the, quote, next several years, corroborating what I've discussed in December's most important and bullish gold chart you'll ever see, i.e. that even mainstream analysts are now forecasting a gold mine production decline of roughly 20% over the next 6 to 7 years. Throw in the COMEX's near record low registered inventories, in gold's case down 80% from its pre-2008 crisis peak to just 870 million worth, and in silver's case down 55% from its pre-2008 crisis peak. Gee, I wonder why physical metals started to be withdrawn en masse after 2008, or 55% to today's paltry level of just $630 million. Which, in light of today's principal topic, which I'll get to shortly, as well as the 100 times amount of paper trading supporting this criminal pyramid scheme, depicts a market perilously on the edge of the physical default we all know is coming, just waiting for the spark to ignite it. Anyhow, this week's COT report showed little change in the gold market, with the commercials naked short position, naked because the aforementioned registered, i.e. available for sale physical inventory, is far less than the paper contract shorted, holding steady at the lowest level since gold's ultimate bottom in December 2015, when gold was nearly $200 per ounce lower at $10.70 per ounce. Likewise, commercial silver shorts remain near their December 2015 lows, when silver was nearly $3 per ounce or 17% lower at $13.75 per ounce. However, the short covering continued unabated in silver, with said commercials covering an additional 2,653 contracts, bringing the total to just under 22,000, comprising notional value of roughly $1.8 billion, compared to nearly 76,000 contracts a month ago and the all-time high of 117,000 contracts 3 months ago. Equally interestingly, COMEX large speculators' cumulative long position has nearly turned negative, in what has typically been considered the ultimate contrary indicator. So while nothing is guaranteed in life, particularly the predictive value of COMEX statistics, it's certainly something worth watching, particularly if said commercials actually go net long, as the last time they were net long the gold futures market was in May 2001, and the silver market, drumroll please, at least 1986, which is as far back as my records go. And FYI, the lowest commercial silver short position on record was 4,093 contracts on the week of June 25th, 2013. Yep, mere weeks after the April 2013 alternative currencies destruction raids, in which just one day after Obama held his now infamous closed-door meeting with the top too-big-to-fail bank CEOs, after which Goldman Sachs, whose CEO, Lloyd Godsworth Blankfein, immediately issued an aggressive short sell rating on gold, gold and silver prices mysteriously plunged for no apparent reason in the ensuing days by 8% and 19% respectively. By the time prices bottomed out in early July, gold was at around $1,250 per ounce, 20% lower than its pre-rate high of nearly $1,600 per ounce, while silver was at $19.35 per ounce, had plunged an incredible 30% from its pre-rate level of around $28 per ounce. It's no wonder that, in the ensuing months, the bullion industry experienced its biggest silver shortage outside of the 2008 financial crisis itself, when the cartel smashed paper silver in its early stages to make sure it wasn't initially viewed as a safe haven asset. Or that COMEX registered inventories plunged by nearly 90% through the end of 2014 to levels that aren't much higher today. In other words, the only time the commercials have undertaken such dramatic short covering have been at times of either major price smashes, major price bottoms, or both. And if the recent major price smash, which required a combination of Janet Yellen's fake hawkish hike in late June and massive attacks during the holiday-shortened July 4th trading week, culminating with July 6th's overnight silver flash crash, only totaled 6% for gold and 11% for silver, which took an entire month to achieve, to levels well above December 2015's ultimate bottom lows of 1070 per ounce and 1375 per ounce respectively. Then this month's rapid short covering may well portend a dramatic decline in the cartel's effectiveness. In the face of the most precious metal bullish fundamentals in our lifetimes, and care of 2 decades of price suppression and fiat monetary destruction, the lowest inflation-adjusted prices in history, which perhaps brings their ultimate, spectacular demise far closer to the realm of imminence from mere inevitability. Speaking of failed cartels, consider the title of my May 26th article, OPEC, like the London Gold Pool, proven cartels always fail. A time-tested theory which, within mere hours on Friday, received 2 major pieces of supporting evidence. The first from OPEC itself, whose fraudulent production cut agreement is not only failing to produce any material improvement in the historic glut that may not reverse for years to come, but is literally coming apart at the seams. Last week's news that Ecuador was formally backing out of the agreement for financial reasons shows just how flimsy such pacts are. And this week's news that U.S. shale production reached a new multi-year high underscores how, for all intents and purposes, anything OPEC cuts will be made up for with market share gains by non-OPEC producers. To that end, the fact that U.S. inventory suddenly plunged the last week has nothing to do with improved fundamentals, but the well-understood fact that Saudi Arabia recently cut its exports to the U.S. significantly, knowing full well that the algorithm-driven U.S. paper oil markets respond to weekly inventory data changes more than in any other market. Clearly, the oil is going somewhere, and Friday's news that, I kid you not, OPEC's cumulative production hit an all-time high should tell you all you need to know about the validity and genuineness of said deal, which is probably why prices declined sharply, and why the oil PPT, i.e. a partnership between the U.S. government and its only Arabic ally in the Middle East, Saudi Arabia, is desperately trying to hype this week's informal OPEC, non-OPEC meeting as a potentially bullish event. That said, the even bigger cartel-busting news of the day came from the auto industry, which, in the face of record inventories, exploding subprime loans and leases, plunging demand, and powerful secular headwinds, was found to have been colluding for years in one of the most vile instances of antitrust behavior ever recorded. More specifically, revelations that German car makers Volkswagen, BMW, and Mercedes have for decades been operating as a cartel, holding secret working groups as far back as the 1990s, in which they discussed, among other things, production costs, suppliers, strategy, and, drumroll please, emissions purification. You know, the concealment of emissions at Volkswagen and numerous other automobile manufacturers, both German and non-German, that has dealt a permanent black eye to the industry, while it's dramatically reducing the resale value of tens of millions of cars. In other words, blowing wide open a cartel that, in the face of the aforementioned factors, will be dramatically weakened, if not destroyed, amidst historically ugly industry conditions that will only be exponentially more dangerous to an industry no longer able to skirt the law to gain competitive advantage. Back to the historically precious metal bullish fundamentals and valuation anomalies that have prompted the most vehemently bullish predictions of my 15 years in the space. See my SGT podcast last week titled No More Downside to Precious Metals. Let's consider the ramifications of last week's historic, and in both cases, LOL, unexpectedly dovish ECB and Bank of Japan policy statements. This mere days after Janet Yellen's equally uber dovish and perhaps more unexpected ding dong the Fed and with it the precious metal bear market is dead speech on Capitol Hill. Following Friday's trading, the net result was an annihilated dollar index at 93.9 at its lowest level since June 2016, more than a year ago. In other words, despite the massively dovish, massively unexpected comments from Mario Draghi and Haruhiko Kuroda, the latter of whom is desperate to be reappointed Bank of Japan chairman next year to avoid the ultimate loss of face. Both the euro and yen surged against the dollar. An incredibly notable achievement, particularly because, in the face of the final death of Obamacare repeal and replace legislation, amidst a plunging economy in which none of the Trumpflation platforms of lower tax rates, increased fiscal stimulus, reduced regulations, decreased military entanglements, or a balanced budget have even a chance of occurring. This, as America's political system is tearing itself apart amidst an era of historic dysfunction, a blatantly obvious soft coup against the president, and generally speaking, chaos and ineffectiveness unlike anything witnessed in U.S. history. Which frankly shouldn't surprise anyone, given that this is always what occurs in the latter stages of a dying empire's demise. To that end, money market odds of a LOL rate hike at this Wednesday's FOMC meeting are currently 3%, and just 8% for the September meeting 3 months later. Heck, even the December meeting now has just a 48% chance of producing a rate hike, which frankly is only this high due to the handful of remaining investors having been so dumbed down by the historic manipulation efforts, particularly since Election Day, that have produced dot-com valuations in the Great Depression era and record low volatility amidst the most uncertain economic outlook in generations, that they remain stubbornly reluctant to give up the ghost on the fraudulent Trumpflation meme, let alone Fed hawkishness that, for anyone listening without an agenda and a handful of brain cells, knows full well died last week when Whirlybird Janet shocked the financial world with one of the most hyperinflationary comments ever, i.e., because the neutral rate is currently quite low by historic standards, the federal funds rate would not have to rise all that much further to get to a neutral policy stance. In other words, abruptly ending the, quote, tightening cycle that never started. Unless a 1% Fed funds rate and an unchanged, still record high $4.5 trillion balance sheet can be considered tighter, whose relentless propaganda support commenced coincidentally right around the time of the aforementioned closed-door meeting of April 2013. To that end, particularly in light of the historically egregious financial market and precious metal valuations that 4.5 years of historic money printing, market manipulation, and propaganda have created, the upcoming months have the potential to represent historic political, economic, and most importantly, monetary inflection points, not just for this painfully destructive extended cycle, but for posterity. Not to mention for the rapidly dying gold cartel, which I might add was dealt an additional, potentially mortal blow on Friday when Bitcoin's SegWit or segregated witness scaling protocol was locked in, which I discussed in detail in Friday's must-read Bitcoin SegWit Activation, the Gold Cartel's Worst Nightmare, in which I concluded with the following paragraph, which I suggest vehement precious metal advocates, like myself, read at least twice to fully digest its profoundly bullish message. Quote, if precious metals' inevitable surge is caused not by a catastrophic monetary event, but simply a diversion of the powers that be's attention by Bitcoin, gold and silver holders may well get to actually enjoy the financial windfall they've been waiting years, and for some decades to occur, as under such circumstances, it could actually occur in an environment not characterized by economic and or monetary disaster. That's coming down the road, of course, like a runaway locomotive on an icy downslope. However, as the world is about to realize that precious metals are not currencies, but instead the best wealth storage asset the world has ever known, they could easily rise 5, 10, or even 20 times in the modern monetary world without catalyzing the draconian government responses that perpetually loom over the sector like a sword of Damocles. In other words, for the first time in generations, it's okay to start thinking of precious metals as investment opportunities, as opposed to the long-standing propaganda that they are only to be considered insurance against cataclysm, which of course they will continue to be irrespective. Anyhow, with financial media headlines, both fake and real, shouting of the deflation fears central bankers are fearing more than ever. Heck, U.S. money supply growth was reported on Friday to have fallen to its lowest level since, drumroll please, the height of the late 2008 financial crisis. How will they react to the dollar's recent plunge? Let alone with Janet Yellen, Haruhiko Kuroda, and to a lesser extent Mario Draghi, in light of the massive failure negative rates and historic QE have been in Europe, given that the former two are desperate to be reappointed as central bank chairman early next year. Not to mention the fact that Janet Yellen's new boss, Donald Trump, not only has little, if any, respect for her, but has demanded that she be a, quote, low interest rate person like himself, the self-proclaimed king of debt. And that if she wants to keep her job, wink, wink, she had better do something about the, quote, too strong dollar, which is killing us. Frankly, the list of potentially hyperinflationary and global trade destroying variables is too large and broad to comprehend. And heck, I haven't even mentioned China, whose own economy is plunging, with the potentially historic National Congress of the Communist Party of China, an event held once every 5 years, upcoming this fall. However, the one thing I do know is that the final currency war I first warned of 4.5 years ago is about to be taken nuclear, now that the fraudulent Trumpflation dollar surge has not only run its course, but violently reversed. To that end, not only has Janet Yellen painted herself in a corner with last week's uber dovish speech, which may well produce far more excitement at Wednesday's FOMC meeting than currently anticipated, but she has put Kuroda, Draghi, and the entire global central banking community on notice that if they want the LOL 2% inflation they so desperately desire, they're going to have to step up their hyperinflationary efforts. Now that not only the euro and yen are surging against the dollar, but even most second and third world banana republic currencies. Ah, the poetic justice of fiat regimes, which no matter how eloquent the magistrates that manage them, or how technologically advanced the market manipulation that sustains them, remain garden variety Ponzi schemes, no matter how you slice it. And given that, without a doubt, the exploding debts, crashing economy, historic wealth inequality, and surely collapsing currencies signify this one to be in its malignant terminal phase, it's only a matter of time, perhaps very little time, before the big one inevitably hits, destroying for posterity the thousand-year economic cancer known as fiat currency. And on that note, I am going to enjoy my Sunday. I will be back, though, early tomorrow morning to finish up this audio blog. Okay, it's now Monday morning, with gold trading at $12.57, a full $25 above its 200-week moving average. And over what was generally speaking, quiet summer weekend, nothing major happened, other than another major shakeup in the Trump White House, a vicious verbal battle between Iran and Saudi Arabia, a poll showing that the banker's puppet Emmanuel Macron, just 1 month into his soon to miserably failed presidency, experienced one of the biggest approval rating drops in French history, and oh yeah, the beginnings of what could, under the worst case scenario, morph into a redux of the 1979 hostage crisis. That said, I'm in no mood to focus on PIMBEEB headlines this morning, given the importance of what I scripted yesterday and what I'm about to discuss, which is that the unprecedented hyperinflationary liquidity explosion of recent years, which due to the definition of Ponzi scheme is about to get much larger, will shortly yield an historic bull market in scarcity assets. Now, the motivation for this topic was a conversation I had with a casual friend and soccer teammate this weekend, which all comes down to the Economics 101 concepts of scarcity and value, of which I'll start by saying that not everything that's scarce is valuable, yet everything that's valuable is scarce, be it love, money, or peace of mind. Which brings me to why I first invested in the precious metal sector 15 years ago. As of 2011, exclusively in physical metal, after learning from a decade of paper PM investing how dangerous and for all intents and purposes unwinnable that mugs game is, i.e. the scarcity and unique characteristics that have made them valuable for 5,000 years, which per recent articles like the most important and bullish gold chart you'll ever see, the holy grail of bullish silver statistics, and platinum, the forgotten precious metal, are about to become far scarcer, given the massive production declines anticipated following 2 decades of price suppression, and from a mining standpoint, the increasingly obvious realization of how, well, scarce they truly are. To that end, scarcity comes in many forms, like fine art, classic automobiles, prime real estate, and countless other asset classes. However, none of these are liquid, and all have highly subjective values, which is why precious metals have been so valuable for so long, and likely will continue to be for generations to come. And the same goes potentially for Bitcoin, which still has a lot to prove on the storage value front, but thus far has unquestionably started to display significant monetary properties, which, as discussed in Friday's Bitcoin SegWit activation, the gold cartel's worst nightmare, may well become far more monetary in the coming weeks and months. That said, the value associated with scarce assets, in my very strong view, will rise at least as much due to the inflation of the currencies they are denominated in as any perceived increase in their intrinsic value. The reason being that as the malignant terminal phase of history's largest, most destructive fiat Ponzi scheme races by, central banks will be forced to print more and more currency units to prevent it from instantaneously collapsing. This is exactly the message Mario Draghi, Haruhiko Kuroda, and Janet Yellen gave last week. This in an environment of record stocks and stock valuations, no less, which of course are due solely to the historic hyperinflationary liquidity explosion noted above, with a little aid from manipulation operatives like the Fed's Open Market Operations Desk, the President's Working Group on Financial Markets, the Exchange Stabilization Fund, and of course, the Gold Cartel. And trust me, the second Yellen's subtle hints of the end of the tightening cycle that never was morph into intimations of new rounds of stimulus, the value of scarcity assets will go hyperbolic. To that end, my friend at our soccer game Saturday told me that several of his colleagues from a tech company that recently went public at a very high valuation visited some Chicago-based funds seeking capital for a new business venture. One in particular, which ran the family offices of Mark Zuckerberg and several other technology sector titans, told him they have $30 billion of liquidity to invest in whatever it wants. Yes, in a world of historic money printing and market goosing, so much capital has been created that a single family office has $30 billion to invest. And when you consider that there's at most 2 billion ounces of investable silver in the world, and probably a tenth of that in gold, and only a few million bitcoins, you realize just how much liquidity could be chasing scarcity assets. I mean, there are now more than 1,800 billionaires and 15 million millionaires. And that's just individuals, excluding the tens of thousands of institutions with at least $1 billion to invest. To that end, there's at least 200 trillion of debt in the world that central banks will do anything to prevent from defaulting. In other words, the amount of liquidity in the system is unprecedented, whilst the amount soon to come could be far more. And don't forget for a second that, given that said manipulations have produced, for the first time in history, dot-com valuations in a Great Depression era, there's a very strong chance that much of this capital could shortly be leaving the vast stock and bond markets for the far smaller and scarcer precious metal and Bitcoin markets that, per my must-read May 2016 article, will, in my very, very strong view, be the twin destroyers of the fiat regime. And given exploding levels of political, economic, and monetary chaos on a worldwide scale, it would not surprise me one bit if shortly turns out to be a lot shorter than most can imagine. To that end, the need to protect yourself from what's coming, financially and otherwise, has never been more urgent.